Welcome back to Global Money Talk by Sampro TV, live from the floor of the New York Stock Exchange. Today we want to take a deep dive into foreign exchange markets, so I'm joined by Tai Wong, independent proprietary trader. Tai, great to have you here today.
Oh, good to be back here again.
Well, first and foremost, we saw quite the global market sell-off yesterday when it comes to equity markets, but what do you make of the price action we're seeing in currency markets this morning?
So currency markets are interesting. I took a look and I saw that the bonds have rallied dramatically, and I think that's because the number of JOLTS job openings are much lower than expected, which makes the market think, oh gee, maybe the Fed will actually cut 50 basis points come September, and that's why bonds have rallied so aggressively, which means rates are lower, and that you've seen the dollar retreat a bit on that. But on the other hand, the job quits were higher, which seems to suggest people are a little bit more confident leaving their job. So a little bit of a mixed message, but the bond markets have definitely taken it, really like this news, and therefore the dollar is a little bit lower. That's my read on it right now.
So in this case, bad news is good news.
Yes, we're a little bit back to this bad news is kind of good news because it will make the Fed want to perhaps want to cut 50 basis points, but really bad news in the economy right now I think is still bad news.
Okay.
So it's a little confusing sometimes.
Yeah, well, yesterday we looked at gold. Today we're looking at the foreign exchange market, and as you mentioned, we kept a close eye on those JOLTS figures this morning, but tomorrow morning we get the ADP report, jobless claims, and of course Friday morning, that all-important August jobs report with non-farm payrolls and unemployment.
It'll be a busy couple of days for sure.
Yeah, and I think it would be very helpful to go over why the foreign exchange market is so important and give us a broad overview of how big it actually is.
So the foreign exchange market in terms of total turnover has grown significantly over the years, and now the number they talk about is $7 trillion in total turnover. $7 trillion is a lot. It's a number that it's frankly hard for me to really think about in my head, but that's all the turnover. That's the spot that's traded for a 2-day settle, and then there are also forwards. It's the entire market. So the number is impressive, and it's because foreign exchange really underlines all of trade in the world, a lot of it, and also all the tourism, all the things that go on. So it's a big market that is at the base of everything. It also is a market it's a remarkable market. It trades 24, we call it 24 5.5. So 24 hours a day, 5.5 days a week. It shuts down at 5 p.m. New York time and then reopens at 7 a.m. Wellington time on Monday, which is typically 1 to 3 p.m. New York time, depending on the time of year. So market's almost always open.
Yeah, I think it's quite significant that sum that you mentioned when it comes to the foreign exchange market, and unlike equity markets, the way that it trades around the clock, I think it's also very helpful for viewers out there to understand. And I think especially in this environment where we're so sensitive to rate differentials, interest rate moves coming out from the world's global banks, I think it's helpful to dive deeper into this market, and especially when we look back to August 5th when there was so much market volatility, and for viewers out there who may not have been familiar with that yen carry trade, then to understand why it was so significant,
yes,
I think it underscores the importance of the FX market. So first and foremost, let's take a look at what the most commonly traded currencies are, Tai.
Sure. If we could get graphic number 1 up. So these are the most popularly traded currencies, and you'll notice that all the numbers add up to 200% because there's always 2 currencies in each transaction. So you'll see that the dollar this graphic shows the difference between 2013 and 2022, and it's every 3 years the Bank of International Settlements publishes this information. So as of 2022, 88%, or if you divide that by 2, about 44% of all foreign exchange transactions involve the dollar. The next biggest is the euro, which is about 15%, followed by the yen, and then some currency that's seen a lot of growth from a low base is The Chinese renminbi is up to 7% or 3.5% of all transactions from just about 1%. So what this means is commodities like energy, like oil, are all and metals are all priced in dollars. So that's why the dollar is so dominant in international transaction. It has been for a really long time.
And I think oftentimes we hear about assets that are dollar denominated, so that's what we're talking about, correct?
Exactly right, exactly right. And if we could have graphic 2, let's talk about the dollar, why the dollar is so dominant. The dollar is the reserve currency.
Yes.
And again, this is from Visual Capitalist, one of my favorite websites. And you can see that the dollar is, why the dollar is so dominant, I think, is actually something that people don't realize, is the American bond market is very, very large. The American bond market here is almost $52 trillion. The next largest bond market is China at 21 trillion, and then Europe is about 22 trillion if you add up all those little yellow numbers together, the little yellow section of that circle, of that sort of funny pie chart. The reason why our American debt is important to the dollar as a reserve currency is people need return on their investments. So if you want return on your investment, you have to find someplace safe to put your money. The United States is probably the safest place to put your money, and you can get a real return. You can get a return in China, but there may be risks that you don't see in the United States, and it might make people nervous in terms of long-term investments. And the Chinese government has, over the past year, written a piece of legislation and erased a business that was essentially people tutoring kids, private tutors. Private tutoring is no longer allowed. So, but things like that make people a little nervous, perhaps, about owning Chinese bonds long term. So as long as U.S. bonds are so dominant, they can offer a riskless real return. You need dollars to buy bonds, and that's going to be why the dollar, I think, will remain a reserve currency for a substantial amount of time.
And I think when we're talking about the U.S. dollar as the reserve currency, there's a long history, isn't there?
Yeah.
Can you walk us through how we actually got to where we are right now in terms of the dollar being the reserve currency?
Sure. So the dollar's been the reserve currency since about 1944, which was the back end of the Second World War, where our economy was certainly the largest, and we were supplying a lot of the armament and the industry that was required to win the Second World War, and we had supplanted the British pound, or sterling as it's often called, which had been the world reserve currency for probably a century, if not more, and it was because Britain held the place of the United States, where they were really the power, and sterling was impregnable. But World War I and most of World War II showed that a change was taking place. So I'm happy to say as an American that I don't see the dollar giving up that reserve currency status anytime soon. It's very, very important, because being a reserve currency allows you to print a lot of money, to have a lot of debt. So it's, in some ways, it's a virtuous cycle. I just would remind our viewers that the UK tried to run a big deficit, and the government almost fell because they couldn't run deficits that size because they were no longer the reserve currency. That was only a couple of years ago, Prime Minister Liz Truss.
And Tai, I'm glad you gave us that history lesson here, because we're here on Wall Street, in the financial capital of the U.S. at the New York Stock Exchange, and even this building has been around for a long time. So I think it's very helpful to take a step back and understand what we're talking about when we're mentioning the U.S. dollar as the reserve currency. But we know that when it comes to any sort of trading, that there's all sorts of volatility. So tell us about how we see volatility when it comes to currencies, and how the fundamentals come into play here.
Sure. Actually, currencies, even though they're an enormous market, or perhaps they're an enormous market, aren't actually that volatile of an asset. So if we could see graphic number 3, let's take a look at some currency volatility. So the I just picked dollar yen, which is, for many of our viewers in the Far East, and as well as here, dollar yen, and we'll talk about the yen carry trade in a little bit, is very, very important. A lot of trade between the United States and Japan. There's a lot of money in Japan that gets invested in a lot of different places. So if we look at that yellow box I put at the bottom, the historical volatility over the past year or so of dollar yen has been 12. And that's a measure of standard deviation, and it's probably a little too complicated to go deeply into the math there. But where dollar yen is today, and with historical volatility around 12%, that suggests that the annual range in dollar yen will be 35 yen. So 145 right now. It could be 160 and 125 on both sides. That's a fair amount of movement. But if we look at some other currency pairs, like the euro dollar, the historical volatility is only 6. So the euro is trading about $1.1 to the euro, and that should actually say 13 cents and not $13. But the range should only be about 13 cents. So you could really see 105. 118 for a range in euro dollars, which is actually not a lot. So if we wanted to compare some other currency pairs, dollar Swiss, 7, sterling, 7, the dollar CNH is the offshore Chinese yuan, renminbi, 5, Korea is at 8. Now look at some of the other asset classes. The S&P 500 is actually at 17, and NVIDIA has been all over the place, and we love talking about NVIDIA, but NVIDIA is at 60. So that means they move your stocks and the individual stocks certainly move a lot more than currencies.
I think it's really helpful to see that comparison with other currency pairs as well as S&P 500 and NVIDIA, as you just mentioned. So thank you for giving us that comparison. But sometimes when we're talking about currency pairs, we hear about safe haven currencies.
Yes.
What does that mean?
So safe haven currencies are currencies that people run to when they sense a problem in the markets. The dollar tends to be one of the favorite ones because the dollar is generally quite solid. The Swiss franc is another one, and also yen sometimes is certainly for Japanese investors. When there's lots of problems, they want to bring their money home. So the dollar goes down against the yen and the yen rallies. So when there's a big disaster in the globe, you'll see the dollar higher, the Swiss franc higher, and interestingly, the yen higher, against the dollar. So those are some of these safe haven currencies. And probably a good time you mentioned it before, and it's worth talking about, is the yen carry trade.
Yes, absolutely.
If we could see graphic number 4, let's talk about this famous or infamous yen carry trade and what it's all about. So the yen carry trade, carry is essentially earning interest, earning interest over and above what you would otherwise earn. So why is yen so important? Well, short-term dollar rates are about 5.25%. Now they go, it's not for the full year because the Fed's expected to cut, and the rates will drop during the course of the year. So short-term Japanese rate was just raised from 10 basis points, or 1/10 of a percentage point, to 25 basis points. So if we calculate those interest rate differentials and where dollar yen is today, that's about 600 pips, or we call it 6 yen. Current dollar yen spot about 145. This means that you can buy dollar yen 1 year outright, which means you don't settle the trade today, you settle the trade in a year at 139. Well, if spot dollar yen doesn't move and you get dollars at 139, you'll be able to sell them immediately in a year at 145, and that's your carry trade. That's essentially interest that you've earned because you're holding dollars and you're short yen. Now, you would ask, well, why is the 1 year forward rate at 139 so much lower? The reason is because if it wasn't, everybody in the market could go buy dollars, put it on deposit, get about 5%, and pay only 25 basis points in yen. And if you let's say the outright forward rate was the same as today, you would buy today, sell tomorrow, lock in your 2 currency contracts, and just earn the interest. So the market doesn't allow you to do that because people would take advantage of it and get rid of it very, very quickly. So that's the yen carry trade. Now remember, in the previous slide, we said the range in yen is expected to be 35 yen or so in the coming year. Could be a little less, could be a little more. But remember, you're earning 6 yen, and there's about 35, or you could say even if you took it in half, 17 yen of risk there. So this is not a riskless trade, but people like it because in part, dollar yen has been rallying, so you're getting almost a kicker in your dollar yen, in your interest rate position, as well as the yen becomes weaker. So it's worked very well. But one thing that reminds me is I traded dollar yen for a few years when I started, and dollar yen can go up an escalator, but sometimes it really comes down hard in an elevator.
Sure.
There are days when I've seen 3 days where the dollar yen has dropped 30 yen, or yen has appreciated 30 yen, and it caused unbelievable dislocations in the market because so many people do this funding trade. And it makes me think that yesterday, if you're an investor in the United States or you're an investor in Korea, and you turn on your screen, you're like, the carry trade will give you those days, and you'll probably be okay, but some days are not easy.
Yeah, and Tai, I think you did a great job of breaking down what the yen carry trade is, but if we look back to August 5th, where we heard about the unwinding of the carry trade, I think it highlights some of the risks when it comes to the yen carry trade. So can you tell us a little bit about potential dangers when it comes to carry trade?
So I think an example is the best for this. And in the Asian financial crisis, Thailand, Indonesia had currencies that were very stable, and it became a problem. So let's take a look at the graphic number 5, which is the Indonesian rupiah chart from about the early 90s to not quite today, but just focus on the left-hand part of that chart. So in the mid-1990s, you could probably earn maybe 8% in Indonesia, and dollars were maybe 3 or 4%, somewhere in that range, and was a really good carry trade, and banks marketed it because what the Indonesian central bank did was they controlled the dollar Indonesian rate. They would only let it depreciate very, very slowly. And because they did that, you could safely, and if you look at the very left, that rate didn't move very much for a long time, you could safely put your money in Indonesia, earn the interest, and be safe on your currency exposure. And then in the middle of 1997, Thailand had a problem. Thailand also did this, and one day they were forced to let it go for domestic reasons. The growth wasn't as strong as they needed it to be, and once the cap was released, the central bank's rupiah went from 2,400 rupiahs to a dollar. Eventually, it went to 17,000 the next year, with stopping at 13,000 in 1997, and that ultimately caused a lot of turmoil in Indonesia. It cost President Suharto power and his family power, and they've had a democracy in Indonesia ever since. So one of my very good friends, he's a money markets trader, and he said something I think is brilliant. He goes, "The road to hell is paved with positive carry." So when you can earn additional interest, there's risk involved. There's never a free trade. There's never a free lunch. So sometimes they're really good trades, but sometimes you have to be careful, like we saw in Indonesia.
Yeah, and that does really highlight the risks that are out there when it comes to the FX market and, of course, currencies. So are there any more peg currencies out there?
So I'm happy to say not really anymore. I think the lesson of the 90s really taught central banks that if you try to artificially put a price level on something, you create pressures behind it. Typically, it's people who are trying to keep banks that are trying to keep their currency strong, so they're stable and people want to invest in their country. So Thailand, Indonesia, Argentina did it. They actually had a dollar peg for a long time until I think about 2002 when they were forced to let it go, and the day they let it go it went to 3, and then eventually Argentina has had a really, really tough time in terms of having to fight inflation. But even we go dial back to when I first started in the business, which was at 60 Wall Street with J.P. Morgan back in the early 90s, the European rate mechanism was still there. So all the European currencies were supposed to float within bands. And sterling famously was fixed around 2.4 Deutschmarks. And it was not appropriate and not correct, and eventually that broke down. George Soros, started making his fortune and his fame because of that. So central banks have realized that if we create an artificial price level, we're going to create abnormalities behind it. And even the Swiss tried to do that because you asked about safe haven currencies a little bit earlier. The Swiss franc was so strong, everybody was piling in, and Swiss clocks and chocolate and their brilliant watches got really expensive. And the Swiss National Bank, tremendously wealthy and smart, tried to keep the franc weak, and they couldn't do it. They sold as many francs as they could, and eventually the market pressure became overwhelming, and it caused a gigantic dislocation in the currency markets, and a lot of banks lost a lot of money, a lot of investors lost a lot of money. So I think the lesson is, whatever it is, don't put artificial prices on it.
And I think hindsight is 2020, especially when it comes to some of the lessons that we learned in financial market history. But because you've been entrenched in the space for many decades, can you tell us what some of the lessons are and how the FX market has changed in the last several decades?
Wow, it's a good question because it's changed a lot. In terms of, I think the currency market, when I started, was a big market. The volatility was a lot higher, but it wasn't as big as it was today. I remember when I first got on the trading desk, 60 Wall Street, down the road here, there were perhaps 15 traders and 30 salespeople. And the salespeople would have two phones in their ears, and they would shout, ask prices, and you would shout back. Today, I would say that same trading desk may have 5 traders and 10 salespeople, and there are certainly no more two phones. Everything is on text, on a Bloomberg chat, on different, and it's really efficient. So to give you an example, I used to trade Mark Swiss, and that was before when there was a Deutschmark Swiss franc cross. And I would say, somebody would ask, what's happening in Mark Swiss? And I would shout over, and the salesperson would say, now I can literally have 75 customers online with me at the same time. I type in, oh, this is happening in the Swiss franc. I hit return, and 75 people get an update. So the volumes have grown tremendously. The number of people required has dropped very, very significantly. Volumes are also much higher. The other thing that's really interesting is the spreads that consumers and customers have to pay are a fraction of what they used to be. When there was a dollar Deutschmark, it was 5 pips wide. Now it's half a pip. Sometimes you get enough banks, enough providers, all of whom have slightly different needs. Occasionally you get inverted prices. You could actually buy and sell. You could buy lower and sell higher. So I don't know. I think some people probably take advantage of that. But what's amazing is just with our stocks, we used to have to pay $100 a transaction. Or at least I used to. I think it was before your time. But now it's tiny or it's free. And it's because the market's really efficient. Not having to pay $100 to trade a stock is great. So maybe financial transactions tax. Maybe we should think about not doing that for clients. But the other thing I would say is so much of the market is now electronic. I would say 90, maybe 95% of foreign exchange trading is probably automated, done by algorithms, done by programs. The human really doesn't have to get involved unless it is something a little unusual. Not quite a spot trade if they needed to roll something a little bit further, but you need fewer people, which is interestingly what. There used to be also many banks, probably 50, 100 banks, heavily involved in foreign exchange. And today, the competition is so fierce, the spreads are so narrow that only the biggest banks really do what they call the flow business. You have $2 billion of dollars to sell against the yen, or $2 billion to buy of euros against the dollar. There's really the handful of big banks, and they're the guys who made a big investment in it. There's Deutsche Bank and Citi and Barclays and UBS. The smaller banks actually have to find niches for themselves. So I work for a Canadian bank. They're great in dollar Canada. They have a lot of clients in dollar Canada. That's their niche. They focus on Canada. Certain other European banks might focus on their home countries. But it has really become the very, very big that dominate the flow, and the smaller niche banks that really will look at their home markets or are willing to lend money to certain clients that other banks won't. So, I mean, that's the beautiful thing about capitalism that I remember Ken Fisher once said, is capitalism finds a way. So you can still make money in foreign exchange, but it's just a different way to do it than it was 25 or 30 years ago. So, I mean, the market is, nearly unrecognizable in a generation.
And I think there's so many visuals that you gave me with people having both phones and having to maneuver one phone with the other. And even here at the New York Stock Exchange, when we think about the 80s or even the 70s, the number of actual human bodies that were on the floor compared to today, and of course the advent of technology, how that has changed the business of trading. I think it's also similar to what you were mentioning in the FX markets.
You're absolutely right. And I remember in the late 2000s, I went on the COMEX floor, and the crude pit were 300 people, all of whom were the size of offensive linemen. And they were shouting and screaming, and 2 years later it was gone. It's remarkable how it changes. But I think change comes, and sometimes it's good. Sometimes it's good for the consumer in terms of paying much narrower spreads and seeing real prices.
And access to products as well. So as we head into the final minutes of today's show, I do want to talk about how investors can actually trade currencies out there. So as you mentioned, you've seen the evolution of the FX markets, Tai. So for people who might be interested in learning more or trading currencies, what should they do?
So the currency market is, so certainly American investors aren't very active in currency markets, in part because the volatilities we showed before is actually pretty low. You're talking about volatilities under 10%, whereas you get twice that in the S&P, and if you trade in tech, it's going to be multiple times that. So you'll get a lot more. Boom for your buck if you trade other things. But you can use currency ETFs. Invesco has several of them. So let's quickly look at graphic 10, where I show the Invesco currencies, and just look at the returns in the red box on the right. They're not that volatile. They usually mean revert, which means they go up and then they go down, then they go back up and they go down, and they're just very small gains or losses, even in the last 5 to 10 years since inception. And I think that's why investors, people who are in the medium to long term, don't really trade that so often. But on that note, it is a market that has been a favorite of speculators for a long time. If we look at graphic 11, the reason why it's so popular with speculators, it's a 24-hour market. You can turn on your computer anytime during the week except on the weekend and go ahead and trade this, and trade these currencies. So you can see on the left there are a lot of places that offer some very, very good spreads, maybe a pip or two, sometimes even less, to trade currencies, and they give you leverage. They can give you leverage in most developed countries up to 30 times. So if you put in a dollar, you get $30 of capital to play with. So $10,000 gives you $300,000, right? $300,000. And other places it can be 500 times leverage. Now, this is a casino, and you can tell because IG, which is one of the big platforms, says 74% of the retail investors lose money when trading, on this, with this provider. And I think they put that in just to avoid lawsuits, to be totally honest. But for people who want to trade, it's a rush. You can trade this sort of anytime. Now, we can, and I think part of it is actually, if we could look at graphic 12, a lot of people who used to trade currencies, I think have now gone to trade crypto, because crypto, and I showed Bitcoin moves around a lot.
Yeah.
And you can trade crypto 24/7. That market actually never closes, which is, I think, somewhat unhealthy for the people in that market. You've got to shut down at some point, right? But Bitcoin, I look at it as a currency, and if you look at those two lines, right, the blue line is Bitcoin, and the red line, I believe, is the S&P futures. The Bitcoin really trades like stocks. When stocks rally, when people are happy, when risk assets are rallying, Bitcoin rallies, and vice versa. It wasn't always like that, but it has become like that. So it is kind of a proxy for the stock market. And then I know the one thing I wanted to do is talk about some of the major currency markets today. Let's look at graphic 6. Look at the euro-dollar chart. So that's euro-dollar over 3 years. Well, for about half of that time, you can see it's been sort of in a range. It's not that interesting. We're trying to break up to the top side here at 122, but we may not make it. And just remember that if you want to sell dollars, Europe is not the biggest picnic either. They have a lot of issues. Their growth is a lot slower than the Americans. So I don't think their rates are probably on its way down. Let's quickly look at dollar yen, graphic number 7. And here's dollar yen, and we talked about the yen carry trade. That is a 3-year chart. In the last year and a half, it's been in a pretty stable uptrend. We look like we've broken down here, but I think what that means is, I don't think it means that we're going to dive. I think we start to trade sideways. And just to remember that U.S. interest rate and Japan interest rate differentials are still substantial. So that carry trade will still exist. So if dollar yen drops a lot, I think people will buy it to try to earn that carry. Let's look at, for our benefit of our Korea yen in graphic number 8, for the benefit of our watchers in Korea. It looks very similar to dollar yen, sort of not surprisingly. It looks like it's breaking out of that uptrend. And I would caution that for many of our watchers, that the Korean won is not a fully capital account convertible currency, which means speculators can't go in and buy and sell at the same time. Now, that's great for the country because they can control their currency a lot better and control their economy better. But it also means that sometimes there can be certain mispricings, because without the ability to set the price properly, the price may not be correct. But I think Korea will get there. I think it will take some time.
Well, Tai, we are almost out of time, so I think it's so important to wrap here right now and mention some key data points that are coming up this week, as well as the Fed rate decision, because there are expectations that the central bank will be cutting. And although a lot of that might be priced into the broader market, that is something that I'm sure you'll be paying attention to.
Absolutely, absolutely. Is it going to be 25 or 50 basis points? I think this employment report is going to be pretty important, because the Fed has said that they care about they're not so concerned about inflation, but they do care about employment, or they've essentially said that. So that's going to be the biggest data point of the week.
Okay, Tai, well, thank you so much for the deep dive into FX markets today.